So let's take a look at 2020. Hello, and welcome back to the Retirement Thinking channel. I wanted to make this video specifically to help people who are reeling still from 2020. It was a rough year. And I'd like to share some things with you today to help you grasp what happened, why it happened, maybe how we should have reacted to it better, and maybe help us react better going forward into the future. So let's take a look at 2020. And what an incredible year it was. And unless you were in a long sleep, it was a total roller coaster. One key takeaway from this presentation is that opportunity manifests around uncertainty, and 2020 was the very definition of uncertainty. So let's flash back to January 1st, 2020, and you just woke up from the clearest, most lucid dream you ever had. In that dream, you saw everything 2020 was going to bring with 100% certainty. Impeachment, global pandemic, social unrest and protests worldwide, and a never-ending election. And all of it, for whatever reason, was given to you. And because of what you saw, wanting to protect your nest egg, you decide to abandon your investment plan and jump to cash. So let's start by looking at the impeachment trial. In April, my advisory group was talking about the impact of impeachment on your portfolio. And this was a reasonably big concern to anybody who had money in the market, of course. And impeachment is a big deal. But realistically, we'd gone through this kind of thing before. It wasn't the first impeachment, right? And Bill Clinton, most recently, was impeached and acquitted through 1998 and 1999, and the market wandered, but it was essentially up through the whole thing. And this is what the U.S., S&P, and world indexes looked like from early January through the beginning of February 2020. The performance we see here is very similar to what happened during the initial months of the Clinton impeachment. The U.S. markets were actually up, and the non-U.S. markets were on their way back at this point. Then on the heels of the impeachment and acquittal, COVID-19 shows up. The World Health Organization pulled the alarm on January 31st, and you all remember what it was like. It really broke my heart going into stores and seeing empty shelves like this. It was so strange for me. I remember when store access was restricted because of age. I was standing outside a store waiting to get in when a young mother who needed toilet paper really desperately for her household was told she had to wait for an hour. Thankfully, we talked them into letting her in. I felt terrible for her. Liquor distilleries converted over to making hand sanitizer. Now, in my opinion, this is a good thing. It revealed a spirit of people pitching in together to help each other. And this was a big positive note for me in a very bad time. But would you have ever thought that this would be happening on this scale here? Not in a million years. And yet, here it was. Now take it a notch further. School is out for, well, we're still not sure. And in addition to having to work from home, which many people will tell you added hours to their workday, now families had to take on school duties as well. Now these families had to make a huge shift in lifestyle and behavior that they never would have anticipated. And then add in business closures, taking things to an entirely different level. People working from home or completely out of work and waiting on the word of a governor to allow them to get back at it. Now let's get back to your dream. Even if it was 100% accurate, would you have guessed that worldwide travel would be severely restricted or shut down completely, or that people would be told to stay inside their homes? Would lockdowns have occurred to you? It never would have occurred to me, and I have to wonder if it was this way in 1918. I just don't know. Now, we know that markets respond to unprecedented events like this, but if you'd have checked with me before you went to cash, I would have told you that the best way to be prepared for these kinds of things is by sticking with a truly diversified portfolio. And back at the end of February, we addressed this question: will coronavirus make your portfolio sick? Now, you can look at the history of various outbreaks throughout history: SARS, Ebola, Zika, and how the market rebounded within just 3 months after the peak of the outbreak. Now, this is significant. If I was your advisor, your portfolio would be built to withstand epidemics like this. Now, this is a crazy looking chart. Just stick with me. It's the World Index Performance Chart showing market results while highlighting all of the significant health events that we've faced since 1970. Cholera, dengue fever, swine flu, bird flu. Heck, I remember traveling to England and having to step onto a sponge mat to combat mad cow disease. And while all these pandemics were bad, the world market was resilient. And we've gone through these things before. This wasn't new. On March 10th of 2020, we showed this graphic. The markets will go down, but a correction is no reason to exit the market. Now, you may not realize it, but the S&P 500 has experienced drops from 3 to 48% every single year for the last 40 years. Just because it's down doesn't mean that you abandon a properly structured plan, especially because we know rebounds can happen in an instant and you don't want to miss them. This is why discipline is so important. Not long after, on May 20th, the Wall Street Journal released this about the March 16th market tumble. Not very encouraging. Coincidentally, on March 16th, my advisor group happened to be teaching investors how to survive a bear attack. That was incredibly good timing, yes, but that's what happens when you have a very consistent approach. Historically, you can see that bear market losses are typically quick to recover, and when they do recover, you want to be positioned to participate, not just watch. We know bear markets will happen in our lifetime. Knowing this, you have to ask yourself, is your portfolio designed to withstand a bear attack? Well, I believe it can be. A bear attack can happen at any time. Now, if you're hiking in actual bear country, you carry bear spray and you make a lot of noise. So here are a few tips for hiking in bear markets. First, be bear aware, which means your portfolio risk should be in check. Don't lock in losses with an emotional bailout. Just don't do it. Next, they say it's wise to play dead with a real bear, and maybe it works in the forest, but it definitely applies to this kind of bear. And finally, unlike actual bears, in the investing world you can actually fight back and improve your outcome by buying more when the prices are low and at the very least rebalancing. On March 18th, we shared this piece about the emotional reactions people have to volatility. When people see things are headed down, they get scared and finally end up bailing out because they fear the worst. You may know someone who did this last year. But really, what is the worst? Is it that all companies in the US go to zero? Was the virus going to cause that? Not likely. Then the market turns and starts to climb, and people's fears begin to subside, and they see that the recovery is happening and they get excited. So they buy in after it's already turned, and they hope the upswing will never stop. This is the danger of market timing, and the evidence tells us that our investing behavior should be just the opposite. The very next day, we offered our response to a Forbes article that raised the issue of going to cash when the market drops. It's our opinion that any time an investor puts money into the market, they've paid for the risk of investing, so they should stick around for the payoffs. You wouldn't buy your way into Disneyland and then walk around for a few hours and then leave. You want to make sure you get the rewards. On March 23rd, on principle, based on our regular investment philosophy, our team rebalanced. Essentially, we bought when the prices were low. It wasn't a matter of knowing what was coming or even guessing that this was the bottom. It was because that's what we do under these conditions. In this case, the timing was fortuitous at best. But let's be clear, the rebalancing activity was part of our normal approach and not some forecasting model that told us what to do. Claiming otherwise would be sort of the same thing as claiming to know which slot machine was going to hit. It just wouldn't be true. After the 30% drop on March 26th, our team reassured clients by pointing them back to the market's own history. Now, you don't need to be a Wall Street analyst to look at this chart and recognize that there are more ups than downs. This graphic alone should give you confidence to stick with your long-term plan. Now, how about all the social unrest and protests? Here's a map showing various demonstrations and protests across the country just between May 24th and August 22nd. Now, some of these events were violent, mostly were peaceful, and yet social unrest seemed to spike. But this is not the only time in our history this kind of thing has happened, and we've survived it all before. Being aware of this should help keep you calm as an investor when these kinds of things happen. But it wasn't just here at home. The world saw a huge amount of activities like this during the same time frame. Political and social unrest was global, except apparently in Greenland. Now, back in June, we talked about what we expected to see in the news, but our message was consistent. Market volatility and scary economic news will come and go over your lifetime. Staying committed to a turbulent and unknowable future is part of the discipline required for being a successful long-term investor. Now, this is important. Economic data is only reported after the fact. It's likely that in the beginning of a rebound, the headlines are still going to be reporting on last month's or last quarter's economic results. The headlines are not what's important to what's happening right now, and reacting to news like this can be very counterproductive. We believe the market has basically already adjusted its prices to all the events that we're seeing on nightly news. The market is very efficient in this way. June 11th was a very bad day in the market. Now on June 12th, we showed a look back at this chart listing all the reasons you could have chosen to sell out of the market over the last 10 years. Job losses, corporate bankruptcies, 20% market drops, the Cyprus banking crisis, U.S. government shutdown, Ebola, crude oil dropping 77%, trade wars, and now COVID. And yet, amid all the volatility, here we are. Those who stuck to a plan of maintaining prudent diversification and rebalancing are doing just fine. So when days like June 11th strike, or whenever fear makes you want to sell, stay calm, stick to your plan, and remember this chart. Then, just a few days later on July 20th, we took a look at the market all the way back to 1999. We reminded our clients about the fear in 2003 and how much uncertainty there was in 2008. 2008 saw a terribly steep decline. Airlines literally had planes on the ground because there was no demand. Finding ourselves in a similar situation, we asked, so where do we go from here? No one knows exactly what will happen in the future, but as you can see from the chart, investors who stayed the course and stuck to their plan through each of these significant downturns have come out in a better spot on the other side. On August 21st, we pointed out this stark contrast in the headlines. Remember when on March 9th these bleak stories like the ones on the left were everywhere and kept on coming? But it was only 5 months later in August that we saw the headline on the right. On August 18th, the S&P hit an all-time high. Remember when sticking to your plan paid off? Well, take a look at this. I showed you part of this chart earlier. This is the market during the time period from January now all the way through August. We have the U.S. index, the S&P 500, and the international index. Now you can see the low point in early March and the subsequent recovery that in hindsight, looking at the headlines, you might never have guessed would happen. The international market did lag, but it certainly rebounded, and this is yet one more piece of evidence for why discipline is so valuable. And then it was election season, and we were hit with the never-ending election. 2020 just didn't want to quit. Doesn't it seem like every 4 years we have the most important election of our lifetime? Well, this one was no different. In October, I shared this presentation as a webinar. We talked about the presidential election and how it might affect the market. The battle between these two will be written about for decades to come. But the truth is, and more importantly, the evidence shows, it really doesn't matter which side wins. Most people are terrified of the person they're not rooting for, yet we're all in the same boat because these people don't control the outcomes of the market. The market truly doesn't seem to care. As you can see clearly, there are times when the red team is in control, and there are times when the blue team is in control. And yet again, you don't need to be a Wall Street analyst to see that the trend line continues to work its way upward. Our message has stayed consistent. We counsel people not to worry about the election's impact on their investments. Then in November, we urged investors to stay calm when it comes to your plan. I posted this particular piece on LinkedIn. If you want, go ahead. You can still worry about politics. But when it comes to your portfolio, staying disciplined with a properly structured plan is the best way to avoid stress. In retrospect, looking at the market performance for the whole of 2020, you can see that staying the course was the right move. I mean, look at what we've been through. Now remember what I said at the beginning? You woke up from a clear, lucid dream telling you what was going to happen. COVID, social unrest, never-ending elections. Who would have guessed that the market would have done this? Yes, 2020 tested us, emotionally, physically, spiritually, mentally. Frankly, I'm not sure the test is over. But it also tested portfolios. We literally saw an entire market cycle happen in just a few months instead of the normal time frame of years. As an advisor, I don't take lightly the impact of all that's happened. I'm sure over the coming years we're going to hear some amazing stories. But I also don't take lightly the job my clients hire me to do, which is to take seriously your plan and your intentions so that you don't end up making moves you'll regret. From a high level, looking at the year in total, many people in the industry and otherwise started out asking how high can it possibly go? And then, within a matter of months, asking how low can it go? The news at this time was terrible. The investor conversations were filled with frayed nerves. Good advisors, though, were reminding their clients not to bail out at the bottom. And then, just a few months later, people are asking, is there any way it can go higher? People wondered if this was a good time to get out of the market. But if they had, they'd have been wrong. And yet, here we are, looking at all-time highs again, asking how high can it possibly go? The fact of the matter is that over time, sticking to a good plan works. Regardless of what was facing us at the start of 2020, it would have been impossible to anticipate the reactions and the actual outcomes that lie ahead. Given all that was happening at the time, there's no way you'd expect personal incomes would be going up during the shutdowns. But they did, by $1 trillion. Yes, some of that was stimulus, some of it, because you can expect governments to try to make a difference. Yet who could have predicted an increase in personal income? And what about the idea of spending going down? Spending actually decreased by $500 billion. Now that's not really a surprise, right? But even if you'd wanted to travel and spend your money, so many places were closed or completely shut off, which is understandable. But the net result was that saving rates actually increased. That sounds like a great reaction by the American consumer to me. They tightened their belts, they made it work despite all the trouble. But who would have guessed this? 2020 savings increased by 173% over 2019. So I'll pose the scenario one more time. You wake up in the morning, and again you've had an incredibly lucid dream. Only this time it's about the remainder of 2021. You get all the details about what's going to happen in the world, all the events we're going to face. The fact of the matter is, though, that nobody gets that dream, and nobody really knows what next year is going to bring. But if you had gotten to see what was going to happen last year, it's clear that jumping out of your portfolio would not have been the right thing to do. The same thing applies going forward. Sticking to a well-crafted plan is the right thing to do. Now remember, opportunity manifests around uncertainty. And yes, we still have plenty of uncertainty. My clients have portfolios that are built to sustain what's coming. And if you don't have a portfolio that is fully and clearly diversified, then we should absolutely talk. And if you aren't sure, then getting a comparison would be a good first step. You can find my contact information in the notes below, and of course I'd welcome your call. So that's my review of 2020, at least economically. You've just seen lots of evidence about what people were thinking and fearing, but also evidence about how to respond to what we see and what we hear. We can control our emotional reactions to market news by relying on evidence, and doing that will help us control our investing by relying on evidence. Well, this is the kind of evidence that's in my retirement thinking, and it guides what I do with my clients every day. I hope it helps you get a grasp on what happened and gives you some guidance looking forward. If you enjoyed this video, please like it, give it a thumbs up, maybe even subscribe or share it with a friend. I truly appreciate your comments down below, so feel free to share your thoughts. And if you have any other topics you'd like me to talk about, of course, please just let me know. Thanks for watching.